Hi everyone, this is the 26th of July 2027 and I just finished recording the Weekend with Indiacharts episode 207. Yes, that's how many episodes we've done. It's been going on for a couple of years now and became one of the most watched discussions on the market. Now, of course, for a while it's been me, but Chavan is promising that at some point of time, once he's enabled and we've had some clearances on the whole thing, that we will go back to both of us doing the discussion and having that episode. So that's just a thing. Of course, there are people who like to get that complete communication of what I am trying to say. So that also is a point to think about. But if you want to enjoy the latest episode, just go online to Indiacharts and enjoy it. So let me get on with today's discussion. A lot of things being said about the recent correction. It's been 4 weeks long and it's been going on, and at each stage I'm trying to judge, okay, is it enough? Because I do think overall the market is bullish on a 6-month basis. That means every correction somewhere creates an opportunity to buy into. But how long will a correction go on? Usually 1 to 2 weeks is what we saw previously. But this one has gone on for 4 weeks. Once in a while we get these prolonged corrections. But if they are not deep, then they are essentially time corrections, right? Of course, it's been deep in certain stocks or certain sectors where earnings have been poor. So that has been the main reason behind the weakness that we are seeing in the market. But apart from that, it's not a very, very deep correction. I think that much is clear to everybody. And therefore, just for example, you take the last correction that happened. It was, when Israel, started its attacks on Iran, the market fell for 2 days. And it lost approximately close to 800 points in 2 days. This time we've fallen for 4 consecutive weeks and lost just over 800 points, a little more than the last time, but close to the same amount. So it's more been a time correction than a price correction. And the small and mid cap indices have only fallen big in the last 2 days. Prior to that, they were mostly sideways, not losing anything. So that broad market, when it really comes into sell-off, is also part of the capitulative process of selling. You sell, and finally you give up and sell everything. And I think we started to see that yesterday. So I'm hoping we are close to the end of this. But what I find is interesting is the narratives around it. Like some of it would be, going to be worse for a long period of time. Yes, we have decorrelated from the world. So is it that India is sold by everything else? I'm not sure all the narratives are correct. While we can, sort of agree to some things, disagree to some things. The news and media are talking about, apart from earnings season, Economic Times spoke about Asian markets not being in good health. And I found that very surprising because you know what? Half of Asian markets are at 52-week highs. So somewhere the author sort of missed what part of Asia he's looking at, unless he's looking at Thailand, which has been weak for the last 5 years. Everything from Japan, Taiwan, Korea, Singapore and Jakarta are all making 52-week highs over the last 2 weeks. Maybe one day here and there they did not, but mostly they've been running away almost one way. So when you have that kind of action in Asia, you can't say that it has been bogged down and that is why the Indian market is weak. So that was wrong reasoning right there from the Economic Times front page article. So somebody didn't read into it or understand it. And the second one I found in the business line where they're saying FPI selling. Now this has been going on for so long, this discussion, that when markets are down, it's easy to say FPI is selling, and when markets are up, say DI is buying, and give weightage to our DIs are very strong, retail investors, money flow, and when it goes down, FIs are selling and leaving the country. Fact of the matter is both have been happening for years together, and FIs sell, DIs buy, when DIs sell, FIs buy. So does it really matter? The answer is no, it doesn't matter. What really matters is the direction in terms of sentiment, for which you have to look at the sentiment data, participant positioning. Are FIs really feeling more bullish about the market? Then they express that in terms of their positioning in the index futures. And if they're feeling more bearish, they express that there. So are they reducing, adding? And if you can see a chart of that, which is there in Strike, then you actually get a sense. And right now, throughout July, they were adding shorts, right? So that's not essentially the reason, right? You can't say that it's just the selling in cash, because there was DI buying also. And last time also when the market went up, FIs were selling. So was that the reason? So that reasoning again has proven itself wrong over time. There used to be a time where they were the biggest players in the market and their buying was bigger, much bigger, many times bigger than the DII flows. Now it's no more the case, and therefore we can't really say that. And in any case, if you understand how price dynamics really work, you have to really go to the real estate market, where prices price discovery is much slower than in the stock market. And you understand that when a buyer and a seller meet, they have to come to a conclusive point where they believe that yes, this is the right price at which I want to do this transaction. And if I reach the right price at which I want to do this transaction, that is only when a transaction is going to take place. So when a transaction takes place, then you have a price, right? So there is a sentimental value to it because it's my perception versus yours. Two people are perceiving the prices right and a deal happens. If it's not so, the deal falls apart. You meet many buyers, many sellers, and deals don't happen till somebody who matches with your thought process comes through. So now the same thing is happening in the stock market, except that it's happening at a very, very fast pace in nanoseconds. But it's the same thing. It's sentiment, right? It's behavior. It's your thought that whether you think Reliance is cheap or it's expensive, whether the news of them flying to Russia is good or is it bad. It's good short term, but is it good long term? So short term it may sell off, long term investors may step in and buy. So many different sentimental factors interplaying. And that is why we increasingly study the flows, the data, the sentiment, the behavior, and try to judge what is really going on, what is really the driver behind the price action, rather than simply say, it's just this, which is not, because it's not just the buyer or seller. There's always a seller for a buyer, there's no transaction. But if a transaction happened and prices moved in a particular way, it's because of what they believe about the prices, right? So right now, the disbelief is very, very high. Belief is not just that the earnings season are bad, we don't know how it will improve or get better. The RBI has cut rates a couple of times, but is it really percolating down to credit growth? It's supposed to improve, but it's still not showing up in numbers. And so there's this whole enormity, fear, anxiety around how earnings growth is going to pan out. Having said that, on the other hand, this whole tariff issue has probably bogged people's minds, because you would have hoped that India has a deal by now, and that has still not happened. Maybe they get a mini deal before August 1. That was the hope earlier. But a final deal looks like going into September is what the media is saying. I don't know if US wants something quick and done with at the 1st of August. They'll probably fly down and push India to finally close up on something. But as we saw with UK, India took many years to finalize what is now the new deal, right? So, and again, that is spread out with our interests, being kept in mind over several years, where we will lower tariffs and, improve free trade with UK. Now, something similar needs to happen with the US, where we agree on various terms and conditions of how free trade should actually work. And hopefully we can do that faster, because that would quickly improve sentiment in the market. Having said that, we'll end up looking at shorter term sentiment for overbought, oversold conditions and try to anticipate whether the market should bounce back. Now, will it be a sustainable bounce that will be multi-month in nature, or will it be, a trading range that we'll be stuck in for some time? Remains an open discussion. I've delved deeply into that in Weekend with Indiacharts again, so you should watch that episode, and it should be live in some time. Having said that, and this is Saturday when I'm recording, so by the time you see this video, it could be Sunday or Monday. Also a shout out to people who want to learn this process, combination of sentiment, RMI, Elliott wave analysis, the whole thing, because I believe that science is not singular. One thing doesn't work all the time, but when you combine it, then you're able to execute better. But first you have to learn the individual sciences, which is what we do in level 1 and 2, and then in 3 I come down and put it all together in the live session. So we do live 3-hour sessions every Sunday. Yes, you have to be prepared for that kind of work. You like that learning process, you want to go deep into market analysis, execution, and how to trade or invest, then you should consider Indiacharts mentorship program. So for that, you just call the numbers that you can possibly see at the bottom scrolling over here. You can call any of them and they will detail you on what it is about. The next batch starts somewhere in late September, early October, and that is when you can start participating in the next round. So the current one is already in its 3rd level, final month or 2 of grilling on the processes and how to execute and how to consider things. So tomorrow morning I'll be taking another 3-hour session, as I've been doing for the last couple of weeks with those who are part of that group. So that's it. I'll not go deeper into that. Come back to what the markets are doing. Like I said, it's not just Asia, but it's also various world markets like Europe that have been hitting new highs, right? So Europe has actually been outperforming the US to some degree, but you're also seeing US prop right back up, because the themes, that is the center of all technology. So that's the biggest theme, whether it's AI and technology in the US, that is grabbed the market share on the world, which is why you still see Alphabet beating earnings for this quarter. And eventually those are the stocks people end up chasing. So this is a situation where, unlike 2000 to 2008, when even the tech stocks recovered, they underperformed most of the world, and we didn't see US do as well as others, though it did recover. We've been thinking that will be the case for some time, but the way the US is recovering again, I wonder if that is really the case. It may be possible that all markets do well. This is a very, very different situation, and free trade is one of them, because in 6 months, if you're going to have more free trade with all the deals struck, just think of it that way, then what does the world look like versus what it looks like today? And if it looks better, then just imagine the economic growth in a more free trading world that you can think of. And simultaneously, Trump's strategy to keep oil down, which is usually the biggest factor in inflation, allows us to cut interest rates, not just in the US, but in other parts of the world. Specifically for India, that's good news, that you can buy oil cheaper, so you're not really worried about oil prices. Okay, world economic growth picks up, so your external sector does better, though there will be issues for certain sectors. I mean, IT sector in India, I really, except for particular stocks, are not a great fan of, unless it's a high growth IT stock. I mean, if you're growing earnings at 5-6%, it's a defensive, right? Why do I want to invest in a defensive IT stock? And why am I paying 26 times earnings for that? So it's only people do that as a defensive, and they can't find anything else. They say, chalo, idhar to laga lo, we'll be safe. That is how the large cap IT is dealt with. So that's not a place I want to be when you're in a growth boom, either in sectors in India because of the domestic story, or because global economy is growing, and so there's something else happening, certain other sectors that may do well in that thematic, and you need to figure that out. So you need to chase growth. Wherever the growth is, that's where the money will go. You can't be invested in defensives, so that also means FMCG is out. Pharma is a unique sector. It has its own tricks and trades, though within pharma also hospitals have been the best performing segment, and the others have just been slow and moving along, but it doesn't look like they are too negative. But again, will they outperform growth stocks? Again, a big question mark. So again, it depends on individual stock story and what you anticipate there. So that requires a completely different approach, and sometimes those sectors actually lag behind for almost 5 to 10 years when growth is doing well, and we've seen that already between 2000 and 2010. Those sectors completely didn't perform, and then after that, for the next 10 years, they were the best performing sectors, except for BFSI. And similarly, in the 1990 to 2000, again they were best performing sectors along with IT. But and IT was a new sector joining that at that point of time. So that is how defensive has worked. But in the other periods, everything else, all cyclicals, other growth sectors, core economic sectors, all have done well, PSUs, and then they have actually outperformed the defensive sectors. And that's again what is happening in the post-COVID environment so far. And you should remain focused there. Unnecessarily diversifying into defensives doesn't make sense, except for short periods when you're getting a correction like it was there last year. But once that is done and dusted, so unless you're even rotating, if you're not rotating if you're not an active manager, get out of this, get into that, get out, then you don't need to really bother about defensive sectors. Just stick with the growth themes of your portfolio and do some risk management where stocks stop performing. So some growth stocks may sometimes slow down and break levels, and you need to manage risk there. Other than that, you need to stick with the theme. In fact, it's also showing up that mid and small cap performance versus large caps has again started to outperform. So last year the thought was, we will shift back to large caps from mid caps. It looks like, in hindsight, looks like a temporary theme, because the mid and small caps, after a brief correction, have again started to lead and outperform the large caps. So the large caps are the biggest correction we've seen this month also. So that is the weaker part of the market. The real money is getting made elsewhere. But that doesn't mean large caps won't go up, because that is the sentiment of the economy. If the economy is growing, the large caps are growing at a slower pace than the mid caps. They will be there. They will drive market direction, but the real money gets made outside. So that is going to remain. That is not going to change, is what it looks like, unless this bull market comes to an end. So as long as you're in the same bull market, often the same themes and the same patterns continue to work till its end. And we are not, I don't think yet we are at the end of this bull market. We just had a correction last year, and we are resuming that, and we are in the early stages of resuming it. And sentiment, which had become very, very negative, is now slightly, it's still bad, okay? In some parts, it is slightly reduced. People are just patiently waiting. Some parts, it is still showing a lot of hedging activity and all, when we see the index futures positioning and so on. So that is happening. The short-term sentiment is still bad. The medium-term is still there, but there are some gauges which are saying, okay, doesn't look like people are as pessimistic as below. For example, the amount of puts traded, if you compare that to 1 year ago, or even to maybe Feb and March of this year, is significantly reduced now. Okay, significantly means we've gone below a 2-year kind of range. So that kind of reduction in put trading in terms of volumes signifies that people are less fearful now than they were before, even though some fears remain, which shows up in hedging activity when we see index futures positioning, but it's not showing up in put activity. So this divergence has started, and as we go into the next bull phase, as all these uncertainties go out of the picture over the next month or two, you will see sentiment change dramatically. We will not be talking about negatives anymore, and that's what I think is the most important part of this communication. That be prepared for a period where there's nothing negative. There's just things are going to improve. Where are they going to improve? Where do you go? And how is it going to improve? The entire credit cycle taking off, the capex cycle taking off, interest rates getting cut further than where we are today. I anticipate at least a couple of more cuts in India, not just because inflation is low, and also because the global rate cycle, and US particularly, which has been holding up, when it starts cutting, will create a lot more room for us to also move in that direction. That might happen only later part of the year, but even between that, I think we have room for cuts because inflation data came out much lower than expected in the recent data. So I think the next meeting, I won't be surprised if RBI decides to cut 25 basis points, or at least give some indication that there is room. Okay, so we are going to be going in that direction, and bond yields are still not reflecting it. The 10-year GSEC did bump up at the end of this week. To my surprise, I thought it was already rolling over, and then it bumped up. But I'm not taking that as a trend reversal. In my overall wave count, it's a fourth of something, still has a lot of downside, and should happen. And we should see currency stability as well. USD INR has been moving up for a while, but it's almost reached two standard deviations on the weekly chart, which we call as the upper Bollinger Band. So that's a good resistance level from where it should turn down. Of course, we were at 61% last week, and I said something similar there. It stretched a bit, but it's going very, very slowly. I still think it's a counter trend move. Eventually, USD INR rolls over and we see more dollar weakness in the weeks and months ahead. The only thing to watch out for in the macro backdrop, maybe, in the short term, as we are losing some momentum, is in gold. Though I think in a falling dollar, usually you say gold goes up, but there is some point at which gold and dollar correlate directly, positively. They've correlated upwards positively also in between. There is a case somewhere for it to correct some more or consolidate some more, because there is an overhang. It's attempting to break out on the upside again and again and again. This is the third attempt which it has failed on the top line. It will make a third attempt to take support at the bottom line in the next few days. And if that fails, then it becomes a deeper correction. So don't jump to any conclusion. Just watch the levels right now. If it breaks, be prepared that there can be a deeper cut. Because I know a lot of people have turned very, very bullish, gold, silver, etc. But for some time the correction's not happened. I even tried to anticipate, will it extend? But again, that extension has failed, and therefore we need to be prepared for the opposite as well. What if it pulls back? If that happens, even silver to some extent will consolidate. Okay, it's not going to collapse or anything. It will consolidate and give another good entry point whenever that happens. So those are things I think on the precious metals to think about as people get increasingly interested in the precious metal space. But again, if I find opportunities in equities, they tend to outperform precious metals. It's only in phases where the opposite is happening that you find good opportunities to be stuck with precious metals, which was the last 1 year. I think the next 1 year is really going to be a shift back to equities, which doesn't end the precious metal bull market, but it can lead to a correction, consolidation, and even continuation later on. But equities doing better still is what I think right now from where we are set up for the next 1 to 2 years. So that is the overall picture, and it remains. We've had a bad July, but like I said, the size of the correction makes it more a time correction than a price correction. And once the time correction is done, price action should get us to again correlate with the rest of the world as we start to discount the future and not worry about the current. So that's all from me. Don't forget, I've mentioned already in between the mentorship program. That's one. So here's the number again. Those interested, do get in touch, and don't miss out on this Wednesday's Weekend with Indiacharts, because a very detailed discussion on everything from position sizing, how to deal with markets like they were in the last 1 month. What can you do about it using the tools in Strike? So I went into a deep dive, and that deep dive can be very, very instructive or helpful. So hope you'll all watch that and gain some knowledge from there. So thank you, and see you next time.